So good evening, guys. We'll start with the session, and the session is basically based upon marketing, branding, and funding your startup. So now we have looked all the various aspects of a startup journey. So right from finding a problem statement to generating an idea to validating the idea, and also conducting user and market research. And the final stage where you need to do before launching a startup is to have effective branding and to have effective marketing, branding, and funding strategies. So we'll first look at the uh, marketing and the branding side of the startup. So we can move ahead. Yes. So marketing is one of the most important aspects of running a successful startup. It helps you attract customers. Yes, sorry guys for the internet issue. Yes, we can move on. So as I was saying, marketing is yeah, one of the most important aspects of running a particular startup. So it helps you to attract customers, to generate revenue, and build a loyal fan base. But however, marketing can also be challenging, especially for startups that have limited resources, that have limited time and budget. So how do you market your startup effectively without spending a fortune on expensive campaigns, on tools and agencies? So just take a look yeah, at a very famous startup, Airbnb, which is the home sharing platform that disrupted the the industry by successfully marketing its USP of offering personalized accommodations for travelers. So that is a very good example of marketing your USP, marketing your product to the right audience. So today we'll delve into yeah, these crucial aspects of building a startup, which is marketing and branding. So before going on to the marketing techniques, the marketing tools, we first have to get ready with a few prerequisites. And the very first of one of them would be to understand your market. So it all starts with understanding the market landscape. So we conduct market research using surveys, interviews, and focus groups to identify what industry trends and the customer needs are. And also we analyze yeah, our competitors and we gain valuable insights. And one of the best model to actually know the market is the TAM SAM SOM model. So it allows you to break down the entire market you're going to target into manageable chunks. So the TAM SAM SOM model is the best known by people who want to convince yeah, investors that the market they want to conquer is big enough to deliver a high return on investment. So it is basically yeah, like a Venn diagram. The very big circle being the total addressable market, which is called the TAM. So that indicates the largest market that you can cater to. So the TAM is the total market you could serve with your product or service. So it represents the maximum revenue you could make in the long run if you captured 100% of the market. Okay, and so a subset of that particular thing is called the serviceable available market, which is called the SAM, and that is the market that you could reach now. So SAM is a step lower than the TAM because you're still limited by, for example, the location of your company or the specialization of your company. And SAM is the market that you could actually reach, and this is because the market that you're going to focus yourself on in the long term. The serviceable obtainable market, SOM, which is further a subset of the SAM, is the market that you can reach with the current resources. So the SOM can be used to attract a larger possible market in the short term with the current resources like staff, money, brand awareness, profession, and competition. So basically, everything you have now, what's available and what you have to deal with. So that is all that comes here under SOM. And upon that, we also have one more subset of the SOM, which are the early evangelists. And these are the most potential customers. So officially, this part doesn't belong in the model, but still, the early evangelists are the most potential customers who can help you get a problem solution fit and ultimately help you validate your idea. So, for example, like we'll take an example of a fast food restaurant. So here, the total addressable market TAM would be the global fast food market, the global fast food restaurant market. And we can only achieve this if we are located in every country in the world and had absolutely no competition. But it would be more realistic to estimate two restaurants in two different cities based on the population and the eating habits. So the SAM, which is called the serviceable available market, yeah, represents the demand of your type of product within your reach. So in other words, if you were the only fast food restaurant in the town, then you would have your SAM. But of course, it's also still important to consider your competition. You can't have the entire SAM as a market in this case because you have competitors as well. With the serviceable obtainable market SOM, you take into account that you're only going to have people within a certain area of the city as customers. And in this case, the early evangelists could be foodies who are always looking for the latest dining options, or perhaps people within a 200-meter radius. So the early evangelists are your very first customers who you will receive the most important feedback from. So we should always focus on the SAM and yeah, particularly on the early evangelists because these are the people which will actually validate and give feedback on your product in the very early stages. So after we have we have understood yeah, our market, this will ensure that in the beginning you only focus on the most your potential customers, and this will help us yeah, get a lot of feedback and doesn't let yeah, us waste time on customers who are not yet satisfied with the product. So after understanding the product, we now have to know to understand our USP, which is called the unique selling proposition, and we have to convey it properly to the audience. So we have to define what makes the product or the service yeah, unique. So the unique selling proposition is a factor that differentiates a product from its competitors. Example, so those can be like lowest cost or the highest quality or the first ever product of its kind. And yeah, so generally, yeah. So again, this is a Venn diagram, and here we only have to focus on the winning zone. So generally, people are like far more competitor focused than the customer focused, and it is as though the competitor struggle in the Venn diagram has more importance and pulls attention away from the consumer circle. And interestingly, yeah, this looks only to worsen with time. So that's especially true for industries where the competition is so fierce that it can destroy margins. So anyone who plays that game loses. When an industry moves from top, from competing to competing on yeah, on price. So always we have to mention that it is not so not only yeah, is it important to fight your competitors on their terms, but you also want to define your business that you don't have any competitors. So the winning zone is defined by the absence of competition. We should not compete. We should redefine ourselves yeah, until we are a monopoly. We should be a category of one. We should own the market. In fact, we think about the term that we use in the start, which is called the unique selling proportion. So to apply it, it has to be unique. So ask yourself, are the analysis levels you choose to compete with your own product are unique or not? And if not, you got to work on it. So why is this unique selling proportion so important? So it is important because a strong USP will help a business yeah, stand out in crowded markets with plenty of other goods and services of the same category. Right customers who are explicitly searching for advantages and attributes yeah, highlighted by the USP are drawn in a very clear USP. Yeah, a compelling USP can support a higher price. So generally, customers will buy expensive product or services if they believe it offers it offers value or a special benefit. Companies with a distinct USP typically have a stronger base for long-term success. A USP helps to develop a brand. So brand identification and equity are strengthened over time when customers come to connect a particular advantage or a trait with a brand. So, so after we have discussed the importance of USP, we have a few steps to write and to convey the USP to others. So the very first thing will be to again to recognize the target market, to analyze the competitors, to pay attention to advantages that your special qualities will offer to customers. We also need to keep our USP very brief and very simple for people to understand. We have to aim for a message that is simple and memorable so that the clients can quickly notice it. And yeah, before putting the USP into full effect, we can have a dry run by a sample of the target audience that we want to see their responses. And also, so considering the emotional impact of the USP that can have on your audience, so in marketing, the emotional connections yeah, can be quite effective. So after all that, we have we have built a very strong USP for a particular product. So we also have examples of USP that the companies use to gain traction. For example, the USP of Domino's Pizza is that you can get fresh and hot pizza delivered within 30 minutes or less, yeah, or else it's free. So these are the points that only the particular companies have. So these are the USPs of that particular company, and they are there yeah, in order to gain trust, to gain traction from the customers. So moving ahead, so by now we have understood our market and we have understood the product. We have understood how do we actually convey the product to others. And now we have to we have to set goals. We have to define the success metrics that we have. So basically, here we might have some perception of success that we have in our mind, but we need to quantify them. And for that, we have something called the KPIs, which are the key performance indicators. So so these are classified into four major categories. The first one being the attraction KPI. So we have to measure the traffic that we get from organic, from direct, or from paid sources. We also have to measure the engagement KPIs. We have to measure the conversion rates that we have. We have to measure the percentage of clients who have unlocked the premium features that we have in our website, and we also have to we have to collect the feedbacks that we get from the customers. So moving ahead, we have the value KPIs, which are actually the conversion rates, the paid subscriptions that our customers actually get, and the time users spend daily on interacting with the product. So all these indicators will actually indicate the success of a startup, and we need to have them clear initially. And yeah, in the end, we have the retention KPIs. So it is basically called the churn rate, which is the number of people who are returning to a website for a particular service. So all these success metrics can be defined earlier in order to have your marketing strategies be very clear and be very precise. So moving ahead, so after we have had the prerequisites of us to market a product, we'll now focus on the branding side. So why is branding important? So many people think that so once they have got the exact solution to their product to the problem, once they build the product, so it is so that is it. So they don't need to market, but that is wrong. The customers don't come. So we need to brand the product yeah, in order to gain traction. In fact, 94% of the world's population they recognize the Coca-Cola logo. So it is not that the product is good, but it is that the company has entered into the subconscious mind of the people, and whenever they think of a cold drink, they only they think of that particular company. So that is the strength of branding. So moving ahead, we have the next slide. Yeah. So we have formulated a very simple process to have started branding done in yeah just 10 steps. So we have already covered the first four yeah which is to develop a branding strategy, to discover the target audience, to analyze the competitors, and to understand and leverage the USP. And after that, we need to look at the brand. We need to leverage the brand identity. And to do that, we have to create a name that triggers recall. And we have to build a proper tagline, a proper logo for our brand. And this is important to get into the subconscious mind of the people, so that whenever people think of the particular problem, so only our solution will come into their mind. And after that, we also have to build a robust online presence. And by the online presence, I mean, hello, yeah, yeah. Sorry for the interruption. Yes. So digital presence is crucial for any business who is willing to sell and market its products to wide audiences. The internet is where the potential customers search for products and services. But it is even more important for startups, as it demonstrates that you are a legitimate and trustworthy venture. So we can start by creating a website that reflects the brand identity. The website will serve as a virtual storefront, and often become the potential customer's first interaction with the brand. And this asset is necessary for the potential customers to understand who you are and what your startup offers clearly. And it is essential to guide them to your website to generate leads and to provide detailed information about your product or services. So after that, we have to develop a content strategy that reflects your branding. So when initiating your startup, it's common to concurrently develop your content and the branding strategies as they complement each other. So content, so content includes various forms such as blog posts, ebooks, or digital booklets, papers, webinars, etc. And they all are created to engage potential customers and deliver meaningful value. So content is instrumental in creating a positive brand image aligned with overarching goals and mission. And it reflects the brand's tone, the voice, and the personality, and adds a creative layer that appeals to the audience. So moving ahead, we have to integrate the brand into our business. There is no right time for incorporating a startup branding into your processes. So however, when you've gone through at least the steps discussed above, you can be set up to launch a new asset within your company. So we also have to consolidate all aspects of our brand and present them to the community, the investors, and the stakeholders as a whole. So the last point is to adjust, monitor, and refine the branding strategy. So some say that nothing is more perpetual than changeable. So with well-planned branding for startup success, there is no way of developing a unique identity and leaving it untouched, as it is not a static business asset. So startup branding is an ongoing dynamic process that requires consistent monitoring and adaptability. So as you reach more customers and gain insights into their preferences and the communication patterns, your brand design and the identity will naturally will evolve and adapt to better resonate with your target audience. And at this point, you track and assess the brand consistency, the alignment with your business practices, and the customer perception. Ultimately, your brand should reflect your approach and evolve alongside your startup growth strategy. You have to adapt your brand strategy to accommodate new markets, products, or services while maintaining the key essence of your brand. So this was all about branding, and we also looked why branding is as essential as marketing. So we can move ahead. Yeah. So coming on to the exact here to the actual crux which we were coming into, the marketing side of startups. So when marketing, we learn what the four P's of marketing are and how to use them to market a product or service. So the four P's are the product, service, place, and promotion. The four P's are they're an example of a marketing mix or the combined tools and methodologies that marketers use to achieve their marketing objectives. So the initial one, is the product. So the product is the good or service that is being marketed. So generally, successful products. fill a need not currently being met in the market, or provide a novel customer experience that create demand. So as we work on the product, it is essential to consider the target audience and their unique needs. And here are some questions to consider while working on a product. So what is the product? What does the product do? So does the product meet an unfulfilled need or need? What is the audience, and how is the product different from the others? So coming on, we have price. So when marketing a product service, it is important to pick a price that is simultaneously accessible to the target market and meets the business goals. So pricing can have a significant impact on the overall success of a product. For example, if the price of a product is too high for the target audience, so very few will likely purchase it. So similarly, if you price a product too low, then some might pass it up simply because they're concerned they think it might be of inferior uh, quality or can't lead into potential profit margins. So we have to identify a successful price that we want to thoroughly understand the target audience and the willingness to pay for the product. So after price, we have the place. So finding the right place to market and sell the product is the key to reaching your target audience. So if you put your product in a place that your target customer doesn't visit, so be it online or offline, you will likely not meet the sales target. The right place can help you connect with your target audience and set you up for success. So, for example, you're selling you're selling an athletic shoe. Your target market is the athletes. They're in their early 20s to late 30s. So you decide to market your product in the sports publication and sell it at the specialty athlete show. So by focusing on sports shoes over sports shows in general, you target your efforts to a specific place that best fits your marketing mix. And deciding the best place to market and sell the product will actually yield out good results. The last one being promotion. So promotion is how you advertise your product or service. Through promotion, you get the word out about your product with an effective marketing campaign that resonates with your target audience. And there are many different ways to promote your product. So some traditional ways include word of mouth, print advertisements, and television commercials. But in the digital age, there are even more marketing channels that you can use to promote your products, such as content marketing, email marketing, and social media marketing. So these were the very important aspects of marketing techniques that you need to look upon, and you should ensure that all the four of them are in the right place and they're very clear to you and your customers while you market your product. So moving on, we'll discuss few marketing techniques and tools that many startups have implemented in their journey to gain traction. So they are social media, website optimization, relations, and paid advertisements. So moving to social marketing, yeah. So we have to choose platforms where the ideal customers are active. We have to create engaging content like posts and videos and stories that will resonate with the audience and spark conversations. We also have to respond to comments and messages to build relationships. So content variety is king. We have to keep it interesting. So we have to mix things up with eye-catching infographics for a quick info burst. We have to captivate with short videos like reels, which will showcase the brand of product. We should not underestimate stunning visuals like design posters that will grab attention. So these are the techniques. So hello. Yeah, sorry. Huh. So also, but social media is a two-way street. So we should not just post. We should also jump into relevant online communities and groups where the target audience hangs out. So we should offer helpful insights. We should participate in discussions and build genuine connection. And this will allow us to understand their interests and needs directly. By engaging with your audience, you will create a community around your brand, which will foster loyalty and trust. One more technique of social media marketing would be teaming up with influencers. So we should not just do a one-time ad. We should find influencers who match your brand and work with them over time. We can create a brand champions. We are naturally showing off our products and building trust with the audience. and this will get the brand in front of more people and use the influencer credit to win fans for you. And the last thing is to listen and adapt. Social media yeah, is always changing. We should use tools to track what people are saying about your brand and what's hot in your industry. This will let us adjust our content to stay relevant and keep the audience engaged. So by listening and responding to their needs, we can show that we care and we're adaptable, and we can build yeah, a stronger connection with the followers. So moving ahead, we have something called yeah. So in website optimization, we have something called the search engine optimization. So that is basically optimizing your websites to rank higher in search, yeah, in the search engine results for relevant keywords. So this includes on page yeah, SEOs, like optimizing the website content, the meta tags and the URLs, and off page SEOs, like building backlinks for from reputable websites. And by improving your ranking, we'll be able to drive more organic traffic to our website. So the website is the only storefront and like a physical store, and we want to make it as inviting as yeah and yeah, and easy to navigate. And this is why we use these particular techniques. So we also have something called the conversion rate optimization, and that is basically the number of people, the number of visitors that turn into customers. So not everyone who visits your website will convert into a customer, whether it's making a purchase or signing up for a newsletter. CRO focuses on optimizing your website to increase the number of conversions. So this involves streamlining the checkout process to make it quick and easy, or using the clear calls to action that will tell visitors what you want them to do. Yeah, or like A/B testing different page elements to see what will resonate best with your audience. And also we have something called yeah called retargeting. So this is a term widely used, and yeah, it basically states that not everyone who visits the website will convert on the first visit. So retargeting helps us with capturing those lost leads by showing them relevant ads on other websites that they visit. These ads will remind the potential customers about the product and service and encourage them to return to your website and complete their desired action. And lastly, we have AI chatbots. So these are basically the automated programs that can provide basic customer support and answer the frequently asked questions. And these can have valuable AI uses. So a very obvious use can be to offer immediate yeah, assistance to the website visitors even outside of business hours. And this can help address basic inquiries and keep the potential customers engaged. So chatbots can also collect valuable data from the user interactions, yeah, such as the common questions or the areas of confusion. And this data can be used to improve the website or the FAQ section. And the last thing to have in the website optimization thing is optimizing the user experience. So think of UX as the overall experience that a visitor has on your website. So a well-designed website with a clear layout, with easy navigation and fast loading speeds will make it more enjoyable for visitors to find what they're looking for and then take action. So by implementing these website optimization strategies, we can create a website that is not only informative and visually appealing, but also strategically designed to convert visitors into paying customers. So this was all about the website optimization. We can move ahead to public relations. Yeah. So public relations is all about crafting a positive image for your company and build strong relationships with the key audience. So it goes beyond just press releases and media coverage. So it is a strategic communication process that will influence the public perception and drive business success. So the very obvious thing would be the press releases, the blogs, and etc. We can have we can have official announcement about newsworthy events like the launches, the partnership, etc. We can also partner with journals and with to create blogs about our product. We also have to engage with the community. So community engagement, organizing or sponsoring events, volunteering initiatives, and charitable partnerships to showcase the commitment to the community and the issues that matter. You have to demonstrate the commitment to social responsibility by supporting causes that your audience cares about. And this can generate positive PR and attract customers with similar values. We also have to build bridges with government relations and public policy, like building relationships with the government officials and advocating for policies that will benefit your particular company, or helping the public understand your company's policy issues yeah, through clear and concise communication. So these are strategies that will help you have a good PR among the audiences. So moving ahead to paid advertising. So again, this is the most traditional and the most common tool which is used. But in today's digital world, paid advertising offers a very powerful tool to businesses in all phases to reach their target audience, to achieve specific goals, and to ultimately drive the growth. And the foundation of a successful paid advertising lies in identifying and precisely targeting your ideal customers. We have to know. So platforms like Google Ads and social media, the advertising will allow us to target users based on the demographics and interests. And this laser focus will ensure that the ad reaches the most relevant audience. We can also utilize the existing customer data or the website visitor data to build something called the lookalike audiences. The lookalike audiences are basically groups of people who share similar traits with the existing customer database. And this will allow you to target potential customers with a high likelihood of conversion. We also have to define the campaign goals. We have to increase the brand recognition and build familiarity with your company. We also have to drive more visitors to the website to explore the offerings. Through ads, we can also generate qualified leads by capturing user information through websites and landing pages. And through that, we can drive direct sales or desired action that we want on our website, such as the purchases, downloads, etc. So this was all about the marketing techniques and tools that you can use to increase the brand image, to have a very good spot in the market and to reach the target customers. So this was all about marketing and branding. We can move to funding strategies.
Thank you, Vidit. That was very great, all about marketing and branding. Guys, I'll continue with the funding and investment strategies part. So let's move ahead. So the first question arises is what is it? As it is written that an investment strategy, it is basically a plan designed to help you guys to help investors achieve their financial and investment goals. Your financial strategy, it can depend on your personal circumstances, your maybe like age, your capital, your risk tolerance, and your goals as well. And the investment strategies, they can range from conservative to highly aggressive, including like value and growth investing. And you should also reevaluate your investment strategies as and when your personal situation changes with time. So investment strategies should keep revising over time. After the what, the question arises is why is it important? Now, see, a startup might require funding for one or maybe a lot of the reasons. So, a few reasons which I can give you are maybe prototype creation or product development. You might need it for team hiring, or you require working capital. It could be for legal and consulting services. It could be for raw materials and equipments, or for licenses and certifications. It could also be put into the money can also be put into marketing and sales, or maybe just into office space or some admin expenses. So there are multiple reasons for why money can be useful, and that is where investment strategy and funding comes into play. Now here are let's discuss the steps to fundraising. The first step being need assessing need for funding. Now see, every startup, small or big, they need to assess why the funding is important and the right amount which they need to raise. They should develop You should develop a milestone based plan with like clear timelines regarding what you wish to do in the next say few months or maybe 1 year, maybe 5 year. It should be a milestone based plan with a proper timeline. That's what like is a major part when you need to assess your need for funding. And a financial forecast, you should clearly construct it, and with the projection of what the company development over the given period of time would be. And you should also take into consideration maybe the sales data and also the economic factors, marketing factors, all of these factors while constructing that. After this part, when you have assessed that this is why you need your funding, uh, you move on to the next step, which is assessing investment readiness. You should also question, are you even investment ready, or uh, there is still some time for raising your investment. So it is also equally important to understand if you are ready to raise funds. Now, any investor will only take you seriously if they are convinced about your startup projections and their returns. And investments, what they generally look for in potential startups, you should have a look at it. It would be revenue growth and your marketing position. Secondly, it would be what the favorable ROI is, the return on investment is. Third thing, it could be what the time to break even would be, and what your profitability as a startup is. Or it could be just the startup's vision and your future plans which impresses the investor. It could also be a reliable, passionate and talented team that which the investor is looking forward to. So all of these include investment readiness part. And then, one second, yeah, and then comes the next part, which is preparing of a pitch deck. Now, a pitch deck is one of the most important things, which we'll discuss more about later. It is basically a detailed presentation about your startup in which you outline all the important aspects of the startup. And creating investment pitch is mostly about just telling a good story. Your it isn't like a series of individual slides, but it should flow like a story, and your vision should be directly and properly conveyed to the investor in what you want to achieve by the startup, by this round of funding. And after this, the next step is investor targeting. In investor targeting, listen to this carefully. See, each VC, which is a venture capitalist, each VC firm, they have something called an investment thesis, which is like a strategy that the VC fund follows. It's like it identifies your stage, the geography, your your focus of their focus of investments, and what differentiates them from other firms. So you can have a look at different firms and their investment theses, and then have a look at which is the one which is most suitable or most proper for your own startup, for your own company, and then target that particular investor to have higher chances of getting a funding. And it will really help you to identify the active investors in your space, and their sector preferences also. Maybe it will help you take into account the geographic location, and all of these will help you to interact with potential investors in person. And after this comes the next point, which is due diligence by interested investors. Now, angel investors and VCs, all of these conduct thorough diligence of the startup before finalizing any deal. They look at the startup's past financial decisions, the team's credentials, their backgrounds, everything, because they want to be very sure about the decision they're making. It's their money after all. And all of this is done to ensure that whatever the startup is claiming, whatever you are claiming to them, describing the growth and market numbers, the projections, everything, it has to be verified so that the investor can raise any objections if anything wrong goes later. If this due diligence is a success, the funding is finalized and it is completed on mutually agreeable terms. And after this comes one small point, which is term sheet. Now, see, a term sheet is a non-binding list of like prepositions by which the VC firm by the VC firm at the early stages of a deal. It basically, in short, it summarizes like the major points of engagement in the deal between you, the startup, and the firm itself. It is, and for a VC in India, it typically consists of like valuation, your investment structure, your management structure, and also the share capital, whatever the changes have been made into the shares. That is what the term sheet includes. And all of these are the parts of steps of fundraising. Now, let us discuss some different sources of startup fundraising, which first one of them being bootstrapping. Now, you must have heard of it. It is a very popular source. This involves self-funding of your startup using your personal savings, your family savings, or your friends and families, and maybe the revenue which you are getting from the business itself, or let's say you do crowdfunding. All of these uh, are come under bootstrapping, where you're not really selling your equity to somebody, or you're not raising it from an angel investor or VC. It's just that from your own personal means. You're trying to get money from wherever you can. As I said, it could be maybe your family's money, it could be the revenue you're earning from business, or it could be crowdfunding. The benefit of this is it offers you complete control over the business, but then the risk with it is that you'll have limited resources, because you can't raise like millions of rupees with just bootstrapping. It is very difficult. But again, it does offer you full control, but it comes in limited resources and also a bit of financial risks. The next point being loans. All of us have heard of loans. So we have traditional bank loans, we have SBA loans. SBA stands for Small Business Administration, and we have online lenders that can also provide capital. All of these, one thing that they require is they want a strong credit score, a strong business plan, and also financial statements. Now, benefits may include like you can retain your ownership and potential tax advantages, but then you need to repay the debt, all that interest, and this is what comes into like the disadvantages of loans. Next point being, let's talk about angel investors. Now, angel investors, they are some high net worth individuals. They which invest in like early stage startups, and what they take in exchange is the equity or like the stake in your company, and they provide access to you for capital. They provide you mentorship and also a lot of valuable connections. So angel investors are also very good, but you should be very careful about it because it involves dilution of your ownership. And you should also keep in mind that you will have further rounds of fundraising where the money will be more diluted. So the ownership will be more diluted. So you need to keep that factor in mind whenever you are diluting the ownership of your company. And also yeah, also there could be a potential investor involvement in your decision making, because they are giving money to you, so they might start questioning your decisions, and you might not be able to do everything on your own. That's about angel investors. Coming to venture capitalists or VCs. VC firms, they basically invest in startups which with like high growth potential, and but what they take in exchange is some significant equity. And they're they yeah, while VCs they offer like large sums of money, they offer very strategic guidance and number of industry connections. It comes with significant ownership dilution, and also you will feel pressurized for rapid growth, and there could be exit expectations like IPO or acquisition within a specific time. So after these like we have taken the overview of different sources about startup funding, and let's discuss some techniques for pitching, which is a very important part when it comes to fundraising. Now, so to craft a compelling pitch, it is very crucial for you to secure funding. It is very important for you that it helps you in securing funding. Now, what you need to include in that startup pitch is these points. First of all, being problem. You need to very clearly define what problem your product, your service, your company is solving. You need to explain. First of all, you need to create the need for your startup, and then explain the market pain point and why it's important. Solution. Now again, very obviously, you need to showcase that how it is addressing the problem in a unique and effective way. What is your USP? How is the problem that you're solving? It is different from what the other people in the market are doing. Market size. You need to demonstrate very clearly the size and the growth potential of your market using data and statistics. And this is something which they really look forward to, because this offers a realer picture of how much the potential growth in the startup can be. Coming to business model, you should explain how you plan to generate revenue. The how is the main part. What is your strategy, and how you will achieve profits, how you will achieve profitability. Now, this could involve maybe a subscription models, or you want to do it through advertising or just product sales. All of this, you should be very clear about your whole business model, about how you're actually generating profits and revenue. Traction. Now, in traction, you need to highlight any progress you've made, like the customer acquisition, maybe through graphs, or the revenue generation, how it has increased over time. Maybe it was 2x, 10x, whatever it is. Or you need to show the other companies you've partnered with. All of these show your progress as a startup. And this is also something which you need to very much highlight in your pitch. Now coming to the team, one of the very most important things for a successful company, for which one thing which an investment firm or an angel investor would look forward to would be a strong team, because in the end it's all about how willing you are to give your um, efforts, your knowledge to your startup. And so you should introduce your team members and also their relevant experiences and expertise, and show it as a very strong and knowledgeable team. Coming to financials, you should present your key financial projections again, including the revenue, the expenses, the projected profit over maybe like the next few months, years, dep completely depending on what your startup is. And last point being the ask. You should clearly state the amount of funding that you're seeking and exactly how you plan to use it, so that they feel like their money is being put to a good use. You should very list down that this is your future strategy. This XYZ is where exactly your funding will be going. Maybe it could be into building your office. It could be into hiring new people. It could be anywhere, or just increasing the uh, production of your company. So you need to clearly state how much is the ask and how do you plan to use it. Moving ahead, here are some presentation tips. Let's cover them in short. The first one being conciseness. They investors have a lot of companies coming in day out. So you need to aim for a very short and but an impactful pitch. Typically, to give you a time frame, it should last about 10 to 15 minutes. But as I said earlier, it should convey a story. It should properly convey your vision, and also that a very you have a very strong team, and your projected revenues are increasing over time, your profits are increasing over time. You should show that all with graphs, but it should be very short and impactful. Engagement. You should, again, it comes under the storytelling part, that you should use storytelling to connect with the investors. When you have researched that which investors would be your target investors as one of the steps in startup fundraising. So after identifying the startup investors, uh, you need to now connect with them through your storytelling and make the pitch memorable one. Visuals. Now you should utilize slides with like minimal text but very compelling visuals. Use pictures, use graphs, and it's entirely up to your creativity. But do not fill it up all with text and text and text. It should be very visually appealing for them to actually remember that pitch. And one of the key steps, of course, for everything, confidence is the key. You should prepare your pitch beforehand and uh, like practice it up with your teammates, and you should be very confident and should just come out naturally. It shouldn't look like you're nervous or you don't know what you're saying. You should be very firm in whatever you're saying, very confident, and it should look like you know what you're talking about. There shouldn't be a moment of nervousness there. And now the last point being Q&A preparation. Here, as it clearly says, you should you should beforehand practice whatever the potential questions the investor may ask. You should anticipate them on your own and then prepare clear and concise answers. You should be prepared about whichever question they may throw your way, but you should be honest about your challenges and risks. You don't need to sugarcoat them, and you should demonstrate how you plan to address them. There could be some challenges, but you need to be honest. You need to be honest about them, and of course the investor is going to ask you about them, so you should demonstrate how you will address them and be very clear about them, about your plan to solve them, how you're going to be solving it. Moving on. Yeah. Now, here are some points about preparing investment proposals and negotiating funding terms. Negotiation is one of the most important parts. So see, a well crafted investment proposal, it really increases your chances of securing funding. And let us discuss one by one the things it should include. First of all being a detailed business plan. What will a detailed business plan include? It will include, first of all, your executive summary, your overview of your business, your mission, and the product or service you offer. Just an overview of what you are doing, what services you offer, and the market you are capturing, the market, your target market. Next thing should be in the detailed business. Under the detailed business plan, you should show them your market analysis. You should present research on your industry, your market size, your competitors, your target market, and highlight the trends or the insights that demonstrate the growth potential of your business. And then you should also define the history of the company, its structure, its business model, its revenue model. All of these things should be very clear in your mind and should be very well given in the detailed business plan. And now you need to properly emphasize upon your USPs, which are unique selling points. And this is something which is very important. You need to clearly describe what your company offers and their USPs as well about the products and their services. And yeah, and then you should also show them your operational plan. You should outline the day-to-day operations of your business, which may include like your location, your facilities, technology, your equipments. You can also describe your production process, but this point depends on what your startup is. The next point which you need to focus on would be the financial statements. You need to show historical financial data, or you need to provide the past financial statements, maybe in the form of a balance sheet or a cash flow statement, for like depending on how long your startup has been been in the market. You can provide you need to provide the previous financial data, and it will demonstrate like financial health and performance of your company. And even if it hasn't been long, but depending on what a trend has been going on in your startup since it has started, you should show them the financial projections, like prepare and present projected income statements over maybe the next few years, so that the the investor, is convinced for your startup. And now you should also include here the detailed assumptions and explanations that you're making for these projections. They are also equally important. Now, the next important point would be the use of funds. Now, see, you should offer, as I said earlier, it should be a detailed breakdown of how you will be allocating their funds to the different areas in marketing, in hiring, technology, in infrastructure, in product development. And you should also present like specific milestones and timelines for achieving them with the help of your investment. This shows that you have a strategic plan for utilizing the funds effectively, and you're confident in how you will be able to utilize the money to expanding your startup and giving them the money back in with much more profits. And now you also need to explain about how the business investment will drive the business growth, how it will increase revenue, how you will expand market reach, or also operational efficiency. You can use again the data and projections to support all of your claims, which is very important because without supporting your claims, they are pointless. Next one is ROI, which stands for return on investment. Now, you need to first of all describe the type of investment you are seeking. It could be in the form of equity, it could be in the form of debt, and also the terms of investment. You need to present detailed calculations of what the expected return from the investors could be, or maybe you can showcase some scenarios, the best case, the normal case, and the worst case, to show what the potential outcomes could be for the investment, for the return on investment. And you need to also clearly outline how investors can exit from the business, from the investment, and realize their returns. It could include plans for maybe like going public or acquisition, and all of these include the return on investment. Now, incorporating these elements into your investment proposal will really help you convey your business's potential and increase your chances of securing the funding that you very much need. Now, detailing somewhat more on the negotiating terms. First of all, being valuation. You should Valuation is basically the process of determining the current worth of your startup. And here you need to consider your startup's market size, the growth rate, the competitive landscape, and you need to again highlight your projected revenues, your market penetration to justify why you have given this valuation. Everything should be justified with the help of data, otherwise it stands baseless. And as a negotiating tip, you should be prepared beforehand to explain and justify your valuation with strong data and projections. You need to understand the investor's perspective and then be open to negotiation for a fair and mutually agreeable valuation. Next point being equity stake. Now here you should equity stake is it represents the percentage of your company share that you are willing to give up in exchange for the investment, and it is very important. while dilution of the company will change. You need to understand the implications of this equity dilution on your ownership, and also future funding rounds will also further dilute your ownership. So you need to plan accordingly on how much equity you are diluting each time, how much stake you are giving to the investor in your each round of funding. And as a negotiating tip for the equity part, you should clearly outline the value that the investment will bring to your business and how it will be used to achieve significant milestones. You should be ready to negotiate the equity based on the level of investment and the investor's strategic value. Next point being both seats. You should very clearly discuss the level of involvement that the particular investor will have in your company's governance. Say you were don't just assume in your mind that they will not uh, they will only limitedly interfere into your company's decision making. Be on clear terms with what all things they have a say under, and for what you will be the sole decision maker. So you need to determine how like this investment will impact your decision making and control over the company. Some investors with board seats, they have a major say in decision in business decisions. So it's very important to set clear boundaries and clear expectations. You should aim for a balanced board composition that includes both maybe investor representatives and also independent members, so that the board which is making decisions for your company, it properly aligns with your company's goals and also the government governance needs. Now, exit strategy. You should discuss the exit strategy very clearly with your investor, and you should outline the expected timeline also for achieving that exit. And while it can be important to predict exact timings, but have a clear plan to help and manage expectations and align interests. And a tip here would be to just be realistic and very transparent about your exit strategy. You should highlight your company's growth graph or and your marketing opportunities, your potential acquirers, which can support the exit plan that you're offering. Now, in summary, like all of these negotiating plans just involves finding a balance in between your investors' goals and your goals and interests. But you should be well prepared with the data. You should have clear plans as the one who is presenting the pitch, and we should have a proper understanding of each term's implications and how you will negotiate them successfully. Now, also as a very important advice, you should always seek legal advice to ensure like all of the terms that you're offered are fair and legally binding. This because it is real life and you need to be very clear on the legal terms as well. And yes, so that was all about funding and marketing strategies. Hope you and also the marketing part. Hope you learned a lot in the session. To conclude, we've covered the importance of the marketing strategy and understanding what various funding options are available for startups. And you should always remember to conduct thorough market research to understand your market target audience and the competitive landscape. You should craft a compelling brand identity and also a value proposition that resonates with your customers as well. You should utilize a mix of digital marketing tools and tactics to reach the exact target audience more effectively. And also, you should explore different funding options and prepare a very solid pitch for which we have given you tips to secure the funding that you need, to secure the investment that you need. And yes, that was all about this session for now, your last session. If you have any doubts, you can speak up. Till then, we'll share the attendance QR on the group, and you can give your attendance there. Hi, Praveen. Can you just share that QR on the group?
Wait, can you just share it on the screen so that they can, whoever's here can scan it?
Oh, yeah, yeah, sure.
Also, Kanupriya, there are a couple of doubts on Slido.
Yes, yes, I'll take it up after they've scanned the QR.
Yeah. Sai Vignesh, do you have any doubt? You raised your hand. Yeah, we can't hear you. Guys, if you filled your attendance and if you don't have any doubts, you can leave.
I hope everybody has had scanned the QR. I've stopped sharing it.
Yeah, Sai Vignesh, you can go ahead and ask it out.
Am I audible?
Yeah, you're audible now.
Yes, sir. So I have a doubt. What is seed fund and what is the incubation? What is the incubation and incubation? I don't know
I'm
what
Your
sorry,
is
your
mic,
voice isn't clear.
your mic volume's really low. Can you like turn it up?
seed fund, sir? Seed funding.
Oh, okay. So see, as the name suggests, seed funding. It's like uh, when you have just sown a seed and you're waiting for the tree to grow. If that's like the analogy for it. And it when new businesses have startup costs of like equipments and wages, utilities, seed funding is where it helps them. It's like the initial amount of funding which a small startup needs to like cover costs from maybe product development and to research and marketing costs and expenses, all of these just at the very initial stage. That is what like seed funding it is very helpful for very new businesses with like when they have access to early funds, so they can help uh, help the initial startup growth. Seed funding can really help them.
Thank you. What is pre-incubation, ma'am? Difference between incubation and pre-incubation.
Okay, so pre-incubation is of course the phase which comes before incubation. It's just that when you've gone from your ideation to an MVP, which we had covered in the previous session, from going from ideation into an MVP. When you receive pre-incubation is that phase, like when you're not a fully developed startup with like working space and all. That is what pre-incubation is. While incubation is when you have created the company and you have started to stabilize your business model. You have a proper business model going on, and that would be the incubation phase, like you have your own working space and everything. So this is like the pre-incubation and incubation part.
Thank you, ma'am. By the way, I have another query.
Yeah, even on the Slido part, I think these doubts were only there.
Yes, ma'am. In financial statement, you said in that what is cash flow statement? Is it essential for financial?
I'm sorry, I can't hear you.
In what is cash flow statement, ma'am? Is it necessary for financial statement for investment purpose? Cash flow. Can you hear me?
What is? Can you type in that Slido?
I think he's asking what is cash flow statement.
Oh, okay, okay. I think the name pretty much like explains it. The cash which is flowing wherever, what are the sources from where your cash is coming in? It could be from investments, it could be the revenue of your own startup, and where all it is being invested into. So all of these is part of the cash flow statement. If there are no more doubts, I think we can wrap up the session. Okay, for that question, for early stage startups, see if you're very early stage, then the financial projections might not be um like wouldn't be able to show the past if you haven't already sold anything, but you can still have a projection as a plan that what you want to do in real life to give them an idea of like how much they will be getting in return as an investor. So it just needs to, projections are what, projections are hypothetical, so you just need to take your assumptions surrounding your market. You need to take factor in the product cost and how much your target market is, and then provide what your financial projection would be. Need not provide the past information if you haven't sold anything, but even for an early stage startup, I think you should provide some financial projection when it comes to pitching. I didn't understand your question, the customer validation one.